Hello and welcome to the Doc Podcast. I'm your host, Dr. Mike DeLuke, and it's my mission to help you lead a happier, healthier, and more prosperous life, both personally and professionally. Hello and welcome to this episode of the Doc Podcast. As many of you know, and as it says in the intro, my goal is to help my listeners succeed both personally and professionally. Today's guest is going to be able to offer advice that will benefit you in both of those areas. MC Laubscher is a business owner, investor, financial freedom strategist, fellow podcaster, and best-selling author. He is the founder of Producers Wealth and focuses on helping clients develop alternative wealth strategies for financial freedom and generational legacy building. MC is the creator and host of the acclaimed podcast, Cashflow Ninja, which many of you may have listened to as it has garnered millions of downloads globally and has earned recognition from Entrepreneur Magazine as one of the top 48 podcasts for entrepreneurs. The show also regularly ranks among the top 100 business podcasts on both Apple and Spotify. MC is a member of the Forbes Finance Council and the $1 Million Roundtable, a prestigious group for elite financial professionals. He is also a highly sought-after speaker at conferences around the country, where he discusses cash flow management, how to achieve financial independence, and how to create generational wealth, all of which we will discuss during today's show. MC will talk in detail about the investing secrets of the rich, including a deep dive into the concept of building a family office or becoming your own bank. This is going to be a fascinating discussion that will change the way you think about money management and investing. But before we begin, I do want to add that the content and advice offered during today's episode is for informational purposes only and is not intended to serve as financial or legal advice. For advice relative to your specific situation, please consult with your own tax and legal professionals. So without further ado, let's get on to today's episode with MC Laubscher. Enjoy the show, everybody. Welcome to the Doc Podcast, MC.
Great to be here. I've been looking forward to our conversation.
Yeah, really looking forward to speaking with you. We had an intro call with each other a few weeks back, and I really enjoyed hearing more about your story, how you got to this point. My audience, as I mentioned to you, is really into learning about not just the professional side of things, which I also talk a lot about on my show, but the personal side, and what you do ties into both, which I love because it deals with finances and financial security and reaching financial freedom. And so if you would, before we get into talking about the details of what we're going to go into today, give the audience a little bit of background about who you are and how you got to the point that you're at today in your life and career.
No, absolutely. So I'm originally from South Africa. I grew up in a very, very interesting time during the history of South Africa. And, I still remember as a young kid, Nelson Mandela was released from prison. And then, 3 years later, ran in the first democratically held elections and then became the president. So it was a massive transition from one form of government to another. Mm-hmm. So I remember it was kind of crazy now that I think back at it. But learned a lot, saw a lot, definitely shaped who I am today because I saw what happens when there's uncertainty. There is unpredictability. There's a chaotic environment, right? And I saw some of the strategies that worked and some of the strategies that didn't work, which, funnily enough, a lot of the things that work is great for being a business owner and being an investor, and a lot of the stuff that don't work will actually harm you as a business owner investor. But I came to the United States in 2001. I played in a sports league up here up until 2007. So I had a scholarship back playing rugby in South Africa. So when I came, there actually was a league here in the United States, and I traveled a little bit, but and then I saw that there was a league here and played in the league. But it was a lot of fun. It was up until 2007, and as we were traveling around the country and some parts of the world to just pursue my career still in athletics, I started to read a lot. I was that guy on the team bus and the team plane that read business books, investing books. I was that guy. Mm-hmm. And of course, there's a couple of card games that you were working in between, but for the most part,
well, I guess they go hand in hand a little bit too, right? If you're learning on the business side, maybe it helps you know how much to gamble. Yeah,
exactly. And I loved history. I loved economics. I love to learn why things are the way that they are. And as I was just traveling around and reading, my mom actually gave me a book, Rich Dad Poor Dad by Robert Kiyosaki.
Yep.
And I read that book, and it completely changed the way how I looked at money, how I looked at investments, how I looked at wealth.
What year do you think about this was? Sorry to interrupt you there, but just
this was around 2002, 2003.
Okay, I'll come back to that in a second. That's pretty crazy, but yeah, go ahead.
Yeah, I took action right away, and bought my first property. So yeah, it was 2002, and within 6 months, I bought my first piece of real estate. I put some tenants in them, single family, collected the rent, paid all of the bills associated with the property, and at the end of the month, there was money left over. And I'm like, wow, this is like cash flow, just like in the book. And of course, that's when school starts, right? Especially when it comes with the real estate, when you're dealing with tenants, late payments, damage to properties, and so forth. But that moment of reading that book and then taking action and seeing it happen was a game changer, because at that stage, I always try to think big picture of, hey, what am I going to end up doing with my life? And I was thinking, I had a perfect opportunity here, playing sports and making some money and doing some odd jobs here and there. I can build out a pretty nice real estate business on the side while I'm still playing sports. And then I've got something to retire to, and not, I've seen guys that end their careers and, it could end abruptly, right, by injury. And then all of a sudden it's like, well, there's nothing to fall back on. It's basically you're back to square one, figuring out what you're going to do, who you are. So I figured I'd skip that step on my journey, and I build out the real estate business. What's interesting about that book, Rich Dad Poor Dad by Robert Kiyosaki, and I've read it every single year since the first time I read it. I have this philosophy that sometimes when you read 10 to 15 books over and over, it's almost better than just trying to read everything you can get your hands on. When you read the great books, there's so many lessons in them. You cannot soak it all up. And every single time I reread the book, I picked up something new. When the student is ready, the teacher appears. And I think it was about the third time I read the book, I looked at these overly simplified financial statements, which I love about that book. And I started to see all of the liabilities that I have is someone else's asset. And then I looked at this and I said, well, it's the bank. And I understand, look, I can leverage debt, good debt, and build out my real estate portfolio. So it's a tool. But I feel like I'm just a player still on this board. Who's the board? And the bank is actually the board. So then, at that stage, I said, well, I've got to figure out this whole thing. How do I create my own banking system similar to what the banks have? How do I become my own banker? And in life, it's funny how things happen in threes. Then, that moment happened. I ran into the work of Nelson Nash that wrote the book, Becoming Your Own Banker. And Nelson ended up becoming a great mentor of mine, but I found that book. And then through, my sports network, somebody introduced me to a rugby friend that he was a real estate investor. And I said, that's great. So the two of us got together, and he's like, oh, so you like real estate too? I said, yeah, I actually just bought property, and I'm getting into it. And he goes, oh, so you're doing this? And I said, yes. He said, so he kind of, we hit it off right away. Turns out, like, his family's one of the biggest investors on the north side of the city of Chicago in an area in multifamily, and he came from a legacy family. 3-4 generations in, where they had a family business that generated income. They positioned all of the capital in a quote unquote family bank through this family office structure that they had. And then they would leverage their family bank to buy real estate. And they would do it over and over. And I looked at this very simple system that they had. And I said, you guys created your own board here. You literally created your own board like the banks. So, again, you don't have to be a Rockefeller to do what the Rockefellers do, is always my philosophy. Because the first thing that people say, well, you just started to do that and copy what they do. I said, yeah, I took his model and said, look, if I can generate capital through playing sports and doing other things, my real estate business, and I can position that in a quote unquote my own bank, that's before I had a wife and children, and later a family bank, and then just buy more real estate with that. It makes a lot of sense. So I started embarking on that journey and building that out. And then as I was building my real estate business, I was teaching this in meetups, and I was teaching cash flow strategies, everything that I learned. Both my parents are also teachers. So I love to teach and give back. And people found it extremely valuable. And the more people I taught this to, the more of them started implementing this strategy of becoming their own bank, the infinite banking concept, and they saw massive results. So I ended up starting my company, Producers Wealth, and this is in 2015. So we're 10 years in business, but we started to help business owners and investors all over the United States of creating and setting up their own banking system, and then also coaching them of how to implement and execute this extremely powerful strategy that you find in family offices all around the United States. And then, as I was doing that, I was having these conversations with clients because, in 2015, think back 2015, we weren't as digital and as virtual as we are now. And we used Skype on the internet to do all of our consulting all around the United States in all 50 states. And I was meeting incredible people. And having incredible stories, how they run their business, generating cash flow, how they invest and so forth. So I started recording those conversations. We published it in a podcast, and that podcast has been downloaded millions of times around the world, 180 countries, I think. Wow. The last time I counted. So that really put some rocket fuel on the message and the strategy, which not a lot of people knew about, but is in family offices all around the world. So up to date, where I'm at and what I do, we've helped over 500 families around the United States with Producers Wealth. And we specialize in infinite banking, business planning strategies, and also legacy strategies. And then we still have a lot of fun, having conversations with interesting people with interesting and unique stories and strategies with business and investing every single week on Cashflow Ninja.
Yeah. So then I want to talk about the podcast as well, and Cashflow Ninja and how that goes as a fellow podcaster, and knowing the fun and the exciting part about that. Few things I want to touch on. One, Rich Dad Poor Dad comes up on this show over and over and over again. And it was the fundamental book in my life that changed how I thought about money circa 2004. That's why I asked the year. So again, here we are meeting 2025, having this conversation. You have a podcast. I have a podcast. We're putting this information and content out to help others. Yet it started for both of us essentially 20 plus years ago. Your mom gave you the book. A co-resident of mine, Doug Elliott, recommended the book to me. And a guy I just recently had on the show who's become a good friend, Daniel Camacho, another Worth It Honest. He was on an episode not too long ago, and we went into great detail. He ended up reading the book on a car trip because he had surgery and he couldn't drive. So his mom's driving. So he's reading the book, and it totally transformed the way he thinks about it. So it's just so cool. I actually did reach out after the episode with Daniel. I did send an email to the Rich Dad team. And because we actually did, my wife and I did the coaching too. They had back then, they mailed you VCR tapes. And so,
I did it too.
Did you?
Yes.
It's crazy. I've never met anybody else who did the coaching. Yep. So we went through it, and we did not have the money, as it sounds like you may not have at that point either, to be making that type of investment, but we really saw it as an investment in our future. I think, boy, I don't know if you remember, a couple $1,000s, I think it was, which back then for, a broke resident who just had all student loans, It was significant to save up for that, but we did the coaching, and so after that, I reached out. I maybe was it 2 weeks ago or so. I emailed them. I haven't heard back yet, but I did send them a link to that episode, and maybe I'll follow up again and send them ours, because I think they should know that there's this many people out there who that book really did transform the way you think about money. And we're going to talk a lot about that during the show as well. With the way that you developed this family banking, when people hear that, what is that? I mean, what is becoming the bank, right? Becoming a family bank. If you could, and you don't have to get too granular, because I know that we can get kind of tied down in some of the details, but from a general standpoint, maybe first that 30,000 foot view, and then narrow down a little bit into it, if you would, on what is this? What is this family bank? And is it really hard to do? Do you need a lot of money to do it? And what are the benefits of it?
Yeah, well, I'd love to jump into all of that. One of the things that I would share, there's probably a lot of people listening that are running their practices and are still growing and scaling their practices. And I wanted to start just one of the things that this could solve for you, this specific strategy. Mm-hmm. When you build out your practice, maybe you bought a practice, or maybe you just started it yourself, right? Mm-hmm. You're all in at that stage. In the beginning, you're all in, and you finished school, and there's probably student loans and so forth. So you're all in on making this work. And at that stage too, there's not a lot of options to get started, because, there's not a lot of liquidity in the practice. And then the practice starts to grow a little bit. Mm-hmm. You start to become profitable. And now all of a sudden, they're like, okay, this is growing now. There's extra money available. And at this stage, this is the stage where advisors come in and give you this, they give you this advice and say, look, and you need to diversify, right? You need to diversify at this stage.
Yep.
And what happens then at that stage is that the money that you've been making in the practice and used in the practice to keep growing the practice, you now give to, let's just say, a financial advisor, because you got to diversify. You don't want all your eggs in one basket. Again, not terrible advice, but how you do it, kind of terrible in this situation, because you lose control over your capital, number one, which has been feeding the practice and growing and scaling the practice. So complete control loss. Now you've handed that to someone else that is investing in other people's businesses.
Yeah.
I love Apple. They don't need my liquidity to grow their business. My own business, and people listening, their practices do. Same thing with Tesla. Another fellow South African, Elon Musk. Elon doesn't need my liquidity. My business and your practice needs it. Mm-hmm. And the other thing becomes, once you've diversified that way, well, you're running a business as a practice, and there's 4 seasons of cash flow in any business. Mm-hmm. Every single business on the planet has them. Summer being your highest revenue months, which is pretty simple to run a business when a lot of money's coming into the door. And on the flip side, your winter. So the summer is your peak. It drops down, you slow, you go down into the fall, and then you go into the winter. Now it becomes challenging. Right now, you still have fixed overheads, student loan payments, equipment payments, all these different things, right? Mm-hmm. That's when you actually need the capital the most, because it needs a capital injection for new marketing campaigns, maybe new staff you bring on, maybe another medical professional to just get you out of the winter into the spring, back into the summer to get that momentum. Mm-hmm. Because you've diversified, you now have to go to the bank to get a loan, because you don't.
That's when you're dipping into your lines of capital and your working lines of credit. Yep.
Working lines of credit, dipping into all of that stuff. So where this banking system comes in is, again, you can diversify, but how about you diversify in a place where you don't lose control over the capital? and you can access it at any given point in time to manage the business through the 4 seasons of cash flow, and then also grow and scale the business and the practice when the business and the practice needs an injection of capital. So what we do is, this goes by a couple of names: infinite banking, bank on yourself, private reserve strategy. There's a couple of different names that people have used for this. But basically what you do is you position the capital outside of the business. Again, you diversify into a separate vehicle. And we use life insurance for this. I know when people hear that term, their eyes start to roll, because most people just understand life insurance as a vehicle where somebody has to die instead of, or somebody has to die in order for somebody else to benefit. But how this is used and how the ultra wealthy and the ultra affluent and family office families use this is they see it as an asset class, just like real estate. It's the exact same thing, because you can structure life insurance just like a supercharged savings account. It's guaranteed to grow. And if you structure it correctly with a mutual life insurance carrier, and we use a dividend paying whole life insurance policy with a mutual life insurance carrier. If you structure it correctly and optimize it, you get dividends too. This is all tax-free. So tax-free growth, tax-free dividends. You'll never pay taxes on that money in that bucket ever again with the correct strategy. The beauty of this is because it is an asset. The bank looks at life insurance, and we work with a lot of banks around the United States. They love this as an asset class, and they would loan against this asset class the same way a life insurance company does, because it's a very, very strong asset. If you think about collateral, real estate, great collateral. That's why you can get lending on it, right? There's other collateralized strategies too. When you have stocks, a certain stock portfolio, there's brokerage houses that would give you a line of credit secured by those stocks, because it's pretty good, pretty solid collateral. The same with gold, silver, art. The same with Bitcoin. I mean, it's one of the lessons and secrets of the ultra wealthy and the ultra affluent, where they don't sell off assets. They place it as collateral and borrow against it to acquire other assets. So this is where the power comes in. When you, the practice owner and the business owner, needs money, you go to the bank of you or your family bank, and you apply for
which would be your life insurance policy in this sense, is that proverbial bank.
That's okay. Correct. You go to your life insurance policy and you get a loan, a policy loan, let's just say, and just for math, inside the policy, you're earning about 6% dividends tax free right now. The lending rate borrowing rate is around 5%, lower than everything else almost that you'll find in the marketplace, because of the quality of collateral that life insurance is. So you borrow at 5%, then you use that money for your business to manage your business, grow your business and your practice, and you repay it just like you would repay any other loan back to this life insurance policy. So I'll give you an example.
So the interest you're paying is going back to yourself? Is that the
interest that you're paying in this example is going back to the insurance company, but you're a holder, a policy holder, and therefore you own the insurance company because you're a shareholder, because in a mutual life insurance company, the policyholders are the shareholders. I'll give an example of how to and this is how they do it in family offices and how we do it, because we have 12 of these policies in our family, and we have our family bank structured. So if my company, Producers Wealth, needs money for bringing AI technology and marketing campaign, we went to our family bank, and let's just say we borrow $100,000 for simple math. The $100,000, the family bank has to get that from the life insurance company, and they're paying 5% to them, right? 5% loan. My family bank loans it to our business at 10%. So the business gets a note just like any other regular loan. And the business now pays, and I mean, think about it. If you're lending, lines of credit for a business, especially a service-based business, right? 10% is a very fair market rate for anybody, and it's actually pretty low. But we would then pay the 10% and the $100,000 back to our family bank, just like we would pay to a bank, But we are in control of this entire process. We have our bank structured with these life insurance policies that's guaranteed. It's guaranteed to grow tax-free. You'll never pay taxes on that money again. You have guaranteed access to that capital in there. And then you could structure this system where your business now always has access to liquidity through policy, through this lending mechanism called the quote unquote family bank. And you get to benefit from it. Think about it.
So are you getting that margin? Is your family bank getting that margin between the 5 and the 10?
Yes, the family bank gets the margin of that 5%.
Yep.
The money inside of the policy, which was the collateral, you never touched that.
Yep.
So that grew with uninterrupted compounding.
Yep.
Tax free, you never touched that. And your business got liquidity, which they could use. And, if you're listening to this, in your world, there's a lot of equipment, right? That people have to purchase. You can use this strategy, buying equipment, repaying it to your own quote unquote bank, your family bank. Your business still has a note, still has a loan, and gets all the benefits from the equipment and all the benefits from, the tax benefits from paying back that loan.
Right. And they get the deduction on the interest, a tax deduction on the interest to the business on top of that.
That's correct. And in this whole entire process,
does it affect the Section 179 ability of things from the business standpoint for purchasing the asset?
No, it does not, because all outside of the policy, it's not like an IRA where it's inside the vehicle. So it's all outside of it. So, Nelson Nash used to say, you need to be in two businesses in life at all time. You need to be in the business that you're in, the practice that you're running, and you need to be in the banking business. Because he said, think about it, MC. If you go to your bank and you deposit money, whether you save it, whether you spend it, or whether you invest it, the bank makes the money. If you go back to that same bank and you borrow money from them to save, to spend, or to invest, they make money. They make money in every single scenario. And that should be you and your family. And this is just a structure and a strategy that's been around for 170 years. It's a very, very powerful strategy. And it is used by the wealthiest families in family offices inside of the United States.
And can you do this? Let's say you don't have a business and you're just working for somebody. You don't own your own practice yet. Maybe you don't have a desire to. Can you set up a similar structure for, say, a car loan or a home equity? Let's say you want to do some improvements on your house. Can you set up this same type of structure if you don't have a quote unquote business to do it with? Hey everybody, I want to take a moment to tell you about this year's Airway Palooza, which is happening October 17th and 18th in beautiful Fort Lauderdale, Florida. This year's theme is From Downstream to Upstream, the life-saving shift, and will focus on something I'm a big proponent of, which is solving root causes to promote airway health as opposed to simply treating symptoms. That's why I'm honored to be co-chairing this event, and we have an amazing lineup of speakers, including general dentists, orthodontists, pediatric dentists, oral and maxillofacial surgeons, ENTs, board-certified sleep physicians, myofunctional therapists, lactation consultants, and craniofacial specialists, all in one conference setting. There will also be social events both evenings, so you'll have the opportunity to meet and brainstorm with colleagues beachside in Fort Lauderdale. Airway Palooza is the only airway-focused event to be nominated for Best Dental Conference of the Year. Plus, as a special gift for listeners of the Doc Podcast, you can receive a $500 discount off your registration fee by entering the code DOCPalooza at checkout. That's DOCPALOOZA to get $500 off your registration fee. I'll put a code along with a link to the conference registration page in the show notes for today's show. So don't miss out on this opportunity to participate in this amazing collaborative event. Get your tickets to Airway Palooza 2025 now before they sell out. And now, back to today's episode.
You could set up this exact same structure if you're a highly skilled and highly paid professional. This is a fantastic way to, as Robert Kiyosaki would call it, with the cash flow quadrant, he has on the left-hand side, the E for the employee, the S for the self-employed, the B for the business owner, and the I for investor. This is the number one strategy to get you from the left-hand side of that quadrant over to the right-hand side of that quadrant without doing a lot of different things, right? You're doing one tweak of where you position capital.
Yep.
So you could set up this vehicle for you and you could fund it. And then eventually you could start to pay off all of your student loans with it. You could start to finance automobiles with it. You can finance, rehabs and so forth on the house. Absolutely. You just change the system around your cash flow management, whether you're aware of it or not. And most of your listeners are, because they're very sophisticated. There's a cash flow management system that you're currently running.
Right. Even if you're literally just buying groceries and paying rent, you're still part of a cash flow system. Yeah.
Yeah, it's all about establishing your pool of capital, just like the banks, and things are always flowing towards you, and you are the beneficiary and your family of this entire system. So, this is, and also, what should you be thinking about? I think this was one of your questions I did not answer. Who is this for? Kind of like, where should they start on their journey? If you have a 6-figure income, this is already a no-brainer to explore and to look into. And you could start where you're at and start to build it up. When we started 20-something years, almost 2 decades ago, myself of starting this, you start where you're at and you continue to add policies as you build out this family banking mechanism. This is also, by the way, a great vehicle to fund investments with. So we've personally used it to pay off my wife's student loans. We've used it to fund all of our investments, our multifamily real estate portfolio, resorts, oil and gas deals, invest in other businesses, run our businesses with it. It's very, very powerful. And it always puts you in a position of strength. Even if you have to negotiate with lenders or financial institutions and banks, because you have this set up already, it puts you in a position of power as far as negotiating too. Because
of the liquidity.
That's correct. And every single, it's funny, we had a client that we told them how powerful this collateral is when it comes to lending and banks and how they look at it. And then he actually explored, because he wanted to grow and scale to several locations, his business. So he was talking to financial institutions and banks too. And he goes, he was shocked of how favorable they look at it. They see that on, his net worth statement, his financial statement. They're like, okay, he's got some pretty good collateral. So it's a very, very powerful foundational piece. And back to that original 1, 2, 3 kind of like strategy that friend of mine shared that his family office had. You generate your capital in your businesses, you position it in a quote unquote bank, your family bank, and then you leverage that to grow and scale your practice, maybe buy more practices, buy the real estate from which the practices operate from. I mean, the opportunities are endless once you've got this capital system set up.
And if you could talk a little more about the type of structure of these policies. Do you go in on bulk? Is it you need 50,000, say, up front for them? Is it something where you need a lot to get in to start a policy, and can you add to that same policy, or do you need another one at another point?
Very good question. So there's a lot of flexibility of how these are structured. So sometimes there will be a minimum and then there will be a maximum, which is fantastic, because when you run a business, you need flexibility of these payments. So if we just use $100,000, because it's a simple math, let's just say you give yourself the opportunity, the max is 100,000. The minimum would be around 25. Let's just say 25,000 on that policy, and the max would be 100. So you have a lot of flexibility. These policies are also very, very different from other life insurance.
And I'm sorry, MC, to interrupt on that. Just so I'm clear, is that a one-time contribution, or could you make multiple contributions, the minimum being 25, but it can't accumulate or aggregate to more than 100 of contributions?
Yeah, you can make many different contributions, but 100 is where it tops up. And here's just a quick rule of thumb too. Usually these carriers will allow you to put up to 25% of your income, gross income, in there. So that's a good kind of, I like knowing, there's the top of where I could put in. Now let's put it in and start where we're comfortable. So as we learn this, and yes, you could set up multiple policies, because as you're income goes up and your net worth grows, you're going to find the exact same issue that you had before is like, well, where do I put the extra money?
Yes.
It always comes back to this, right?
Yep.
And then I've got an exercise that I run through. Well, do I keep it in a bank? Do I put it in bonds? Do I put it in a 401k or an IRA or a Roth IRA? I go through all of this and I lose control with most of them.
Yep.
I don't have immediate access or guaranteed access with them. And if you want to play the tax game, which is the other thing that you also learned from Rich Dad Poor Dad, if you want to play the tax game correctly, you want to limit the amount of vehicles and buckets that you have in your strategy that's only deferring to taxes to have you pay it later. So look at strategies where you can defer it and keep deferring it and never through proper strategies ever pay taxes on it again. So you start somewhere where you're comfortable with, and then you build this out, and it could take several years. You could have it up and running pretty quickly. When you're young, you've got a lot of runway and a lot of time, maybe not as high of an income or other resources. When you're older, let's just say if you're in your 60s, and there's a lot of our clients and new clients that we find that are 60 years and plus, and people really for this strategy? Yes, because they can have a system fully up and running within 5 years because they have high incomes and a lot of resources and at that point, right? And if you're in the middle, if you're in your 30s and your 40s and 50s too, early 50s, great strategies available because you've got enough time and you have, decent income and resources. So there's a lot of different strategies for folks of how to bring this into what they're doing. That's why I always say we're not reinventing the wheel here. If you have a pretty good system already running, that's great. All you're doing is you're making one small tweak that makes a massive, massive difference.
I love how you're explaining it extremely clearly and helping me understand, because I loosely understood some of this, but to really dive into it and really see that it's not extremely complicated. I agree with you. People hear life insurance and there's that cringe moment, right? Because I think there's been a lot of scams centered around it. Truthfully, I think there have been. A lot of people have gotten fleeced by it. They've had offshore accounts. It's turned into a whole thing. So in a minute, maybe we can come back to and talk a little bit about that, maybe address some of people's concerns therein. Before that, the underwriting side. Is it where you go through a full underwriting because it being a life insurance policy? Do you have to go through underwriting initially every time you get a new policy, every time you make additions to a existing policy? What does that look like?
Yeah, so there is underwriting involved. It is a life insurance policy, so you will get medical underwriting done when you set this up. Now, there's another strategy. So to your second part of that question, do I need to do this every single time I set up a policy? So there's a strategy that I personally follow too, and what you can do is you can have a convertible term policy. Now, this convertible term, you could get, for the maximum amount, let's just say that an insurer would insure you at that time. So combined with your whole life, you could get a maximum amount. And if we just use round numbers, let's just say you set up one of these very specifically structured whole life policies for $2 million and you want $10 million of coverage in place. You could get $8 million in a convertible term. Now, what does this allow you to do? Well, number one, you now have the most cost-efficient death benefit. That is the most cost-efficient way to buy that 10 million. So if anything happens to you, you have a contingency plan that you can work into your estate planning with your family, and then also, with the practice, with the business. But the powerful thing here is you can convert in chunks, like 1 million at a time or 500,000, 2 million at a time of that convertible term over to more whole life without a medical underwriting. So what you've done is you've given yourself the ability to keep adding more of these policies down the line, and grow and scale your own banking system, because
you can't borrow against, or you can't bank with the term, the 8 million in this particular example, 8 million a term, correct? You'd have to convert that into the whole to have it be part of the banking system, so to speak.
Correct. Okay. But it still has the death benefit.
But you still get the death benefit. Yeah.
And this powerful strategy just gives you the death benefit that you would need at that time to fully insured yourself. And it gives you the ability to keep adding these policies into the future because things happen. Life happens. We see bad things happening to good people every single day. And if you have one of these things in place, it's not going to eliminate the ability to keep adding policies in the future. And this just leads to another follow-up question that people have. Well, what if I'm uninsurable right now? Well, there's a lot of different strategies. If you have a spouse, if you're married, if you have children, there's different strategies. There's different ways to set this up, and you could still create and set up this banking system. We just obviously have to be a little bit more creative, but it's not the end of the world if you're not insurable.
Okay. And if you're less insurable, so to speak, like let's say you have some health problems or concerns that would make underwriting more difficult to get, does that just affect the rate that you either gain at, meaning the growth rate or the amount of interest that you're going to get into your policy? Were you saying the 6% before? Does it affect that? Does it affect the rate that you pay out on loans from the policy? Does it affect your premiums? What is that? How does that play out if you aren't as insurable versus if you're more insurable, so to speak?
Yeah, it's going to affect the rate that you're going to get. And again, what we would do is, let's just say we have, a couple, a husband and a wife come to us. We'll do the underwriting. We'll see what the
both have to go through it, husband and wife, if it's a joint policy.
Yes. Okay. So both of them would have to go through it, and we'll see where the writings come in, and then we'll finalize a strategy. We kind of have an idea already going into this, and as we map this up, and that's what we do too. We help you create this strategy. We make sure that the policies are structured just as they're supposed to, that there's no surprises, exactly how it should be set up, because there's a very specific way in doing it. And then obviously we then help folks implement and execute the strategy within the life of their family and their business.
Okay. And the premiums, do you have a premium payment? Obviously in the term portion, I would assume that there's a premium payment. On the whole portion, what does that look like? Once, let's say you do the example you gave where it's a minimum of 25 and it's a max of 100, and you do the 100 as you'd use in your example. What does that look like? How much money does it cost me to put $100,000 of capital into a whole life system? Not about the borrowing or the growth rate, just like what is that going to be my cost to hold that policy?
Yeah, you're going to have insurance costs, which can range from 20 to 30%, let's just say upfront, and that will be your base. And then you will have your portion that goes straight to the savings element. Using that example, if you pay into that capital system $100,000 for 10 years, the first couple of years, you're not going to have the exact same amount of money that you've put in there. Let's just say you put in 100, and at the end of the year, for year one, you have 80,000 in there, let's just say, which is available, right? And you build that up and you have a death benefit. But 10 years into that scenario, you're going to have around, depending on, again, age and underwriting, but roughly around $1.2 million tax-free in that policy with a death benefit, which is now up and running. And that's why I always say to folks, this is a strategy that is one of your foundational strategies. And it is not a get rich quick scheme at all. It's not sexy. It shouldn't be advertised as such. It is an incredibly powerful savings mechanism and system, and a banking system that you have. So I always say, this is the get wealthy for sure way. This is and bold statement, get wealthy for sure way. Well, people have been using this for 170 years to get wealthy for sure, instead of the get rich quick. So in the beginning, there's a build-up phase. Then there's a phase where your banking system, quote unquote, is capitalized, where there's more money into the policy that are now in cash value than what you've put in. And then it just starts to grow exponentially. Keeps growing tax-free every year.
Okay. And then you did say, I heard you correctly too, that the withdrawals of that policy, is the interest gain also tax-free when you take it out, or is it just the initial premium investment that is initial investment amount that's tax-free when you withdraw it?
Yeah. So through very specific strategies, you can actually set up a quote unquote private pension for yourself, that you can draw income from this policy tax-free. Mm-hmm. And you would take the cost basis out first, tax-free, and then you would switch over, and it's a little bit more advanced strategies, but you would switch over to certain loans to take the rest out tax-free. But this has been
to take the growth out tax-free, you're saying. So the cost basis, since you invested post-tax, is coming back to you post-tax. But there are ways to get the gains out without having capital gains on those.
Yep.
Okay.
And this, if you look at a lot of what happens in the corporate world, and there's corporate-owned life insurance, COLI, there's bank-owned life insurance, BOLI, but for a lot of corporate executive compensation packages, this is a strategy which is used, especially Fortune 100, Fortune 500, because they would offer the CEO stock and then also life insurance. And people say, life insurance? Well, if they hit their targets as CEOs for the company, they get, a certain amount of stock, and then they also get a certain amount deposited into this life insurance policy. And then they stay there for 10 years until their contract's done. They walk away with, a tax-free money in the life insurance policy, and then the stock options.
Got it. And to the audience, so I'm getting too granular on this. It's always a balance of wanting to get deep enough so people can really see what this is versus just scratching the surface. So I think if people are still with us at this point, they most likely want to hear some of these details. If this was over their head or they didn't want this, we would have lost people prior to this. But as you alluded to, I've got a really intelligent and savvy audience. I've done multiple episodes myself on cash flow. I've had my own financial advisor. I've had accountants and CPAs, and in a bit of a mode right now where I'm even doing more of these types of episodes because people are emailing me and reaching out to me online and saying, like, can I get more of this? So I really do believe that people are gravitating towards this and thirsting for this type of knowledge. So thank you for being patient with it and walking through it in these steps. When that policy would be converted, are there rules and regulations on how you can terminate the policy or liquidate the policy or a portion of the policy, both your cash basis and any growth?
Yeah, I think so part of the strategy. So a lot of people will say, well, how do I, if I wanted to just end the policy, is that hard?
Right.
You can terminate the policy. You will get the cash value inside of the policy out. If it's over your cost basis, then that becomes taxable.
Capital gains tax on any growth over your cost basis.
That's correct. But in this strategy, because it ties into the legacy piece of your family too, right? Mm-hmm. So if you think about it, throughout your lifetime, you can have this system set up and utilize this system and create your own banking system for you and your family, which you benefit from. And then when you pass away eventually, the death benefit, and again, we have to look at the tax environment. So currently, yes, what is it? Still 25, 26 million for couples. If it's underneath that, that's all tax free still to your family. And again, through advanced strategies and trust planning and so forth, you could structure these things so it'll never be taxable. But we look at that, and Rockefellers call it the waterfall method, right? Mm-hmm. So there's a waterfall of capital if the parents pass away to the children. Mm-hmm. And then that goes straight to their banking system into life insurance.
Okay.
And then they have their death benefits maxed out. And when the children passes away, there's a waterfall then to the grandchildren, which that capital goes into life insurance again. Mm-hmm. And they continue to do their own family banking system. And they max out life insurance on the grandchildren. And eventually, when they pass away, that'll fall to the great-grandchildren. Mm-hmm. So this is part... there's different phases of this strategy. The phase one is just getting this bank set up, building out your family bank, controlling your capital, always have access to capital to grow and to manage your practice and to grow your practice. And then eventually you're acquiring different assets with this. And then the legacy piece comes into play eventually when we pass away. So that's one of the reasons why people would never, ever want to terminate one of these policies, because once it's up and running, it's a pretty powerful system. And this is also why if you ask a family office family, again, a lot of these family office families, they have $100 million in net worth and up. But if you ask them how much life insurance they want to buy as a family, it's a very quick response, as much as carriers will sell them. period. And this is why, because it's how big, you might have rephrased that and asked them, how big would you like your family pool, capital pool to be? And that would be as big as we could get it, right? How much of a waterfall do you want for your children and your grandchildren? As big as you would allow me to make that, which obviously on the other side of the spectrum, and I know you wanted to dive into that too, is why people should be wary about the asset class of life insurance.
If you could, that'd be great.
There's a completely different side to that coin, which is a completely different world, how life insurance is sold to the average person in the public.
Yeah. Could you go through that a little bit of what, I remember when we were residents going back about when I read Rich Dad Poor Dad in the early 2000s, salespeople would come in and talk to us about the importance of different types of insurance and some that we needed. We had no idea. You have no idea. Even know about malpractice insurance or business overhead insurance. You don't have any clue. So it was helpful to start to learn some of that. At the same time, they would be selling these types of policies, insurance policies. And then you hear things or see stories online about fraud in these arenas or people who were misusing these policies, both on the end user side and on the banking side, the people who are designing and holding these policies. So what can you say to give people a little bit more background or assurance into how do you know who to trust in this arena? And what are some of the pitfalls that people should be aware of that can happen in this industry?
So most of the financial advice is tailored towards the average person out there, right? If we think of average, and your listeners are definitely not in the game of average at all, but if you think of average these days, it's pretty depressing because average is overweight, divorce, broke, that's unfortunately the reality. That's the average person. So that's where most of the financial advice is tailored to. The same with insurance. Most of the insurance that's out there is just retail insurance, and it's for the average person to buy a term policy or just a permanent policy, being a whole life or an IUL, just to have enough death benefit to cover a mortgage and maybe burial expenses and that kind of stuff.
Funeral expenses.
Yeah, exactly. Exactly. So the way that insurance is sold to the average person is just retail insurance. So you hear things like Dave Ramsey would say, well, life insurance is a terrible place to put your money.
Yep.
But if you look at the policies that the average person looks at, it's not structured at all for cash value. It doesn't have any really cash value component to it until quite a number of years. You would look at that and say, well, yeah, Dave's right. It's not a good place to park capital if you look at those designs of the policies. The other thing that he also says is that life insurance agents make a fortune selling these policies. And yes, that's another thing that he's correct on, because if you structure this correctly, just how it's structured in family offices, you actually reduce your commission by 70 to 80%. Just of structuring it different. So can you see that there's two worlds that are kind of competing with each other? So it's very, very important who you work with and the professional that you work with, and making sure that these policies are structured correctly. And, there's other ways that it could go wrong too. It has to be structured with the correct carrier. That's one, a mutual life insurance carrier. It has to be structured correctly, meaning for high early cash value, and usually maximize the cash value day one, and you should, within the first 30 days, have access to the capital that you put into the policy. And then the third piece is it should be with the right professional that practice what they preach. They're doing this themselves too. And also they can help and guide you along the way of how to implement and execute this, because it's a strategy, not a product. We're so used to just buying products or buying a pill or something, and it's going to cure all ills, and this is going to be great because I bought this product. No, it's a strategy. It's a strategy that you have to implement and execute over and over. But yeah, there's a massive, massive ecosystem just in the life insurance world. And there's a massive difference how life insurance is bought, again, in family offices and then towards the average person. And then there's a massive difference for the strategies that are available. Again, bringing it back to Rich Dad, Poor Dad with Robert Kiyosaki is, even in real estate, think about it. There could be a property that somebody buys and loses their shirt on, and then another investor would buy that exact same property, and it would be a gold mine for them. It's all about the strategy and how they implement and execute that strategy. So life insurance is very, very, very similar. It's an asset class that has deserved all the criticism it has received. And there's a lot of landmines and there's a lot of pitfalls. Unfortunately, and a lot of scams there. So yeah, you have to do your due diligence and make sure that you're working with the correct people and group and company when you are trying to set up these strategies.
Okay. Yeah, thank you for explaining that part of it. Are there carrying costs outside of that initial, I guess it'd be fee or commission or whatever it would be when you make that investment? Are there annual carrying costs on having this type of setup?
So your death benefit, it will be your biggest cost in this, but there's mortality tables and mortality costs into this. These policies, if you compare it to any other financial, I would say, vehicle out there as far as costs. I mean, I've seen so many different studies done where a stock portfolio versus life insurance and a 401k versus
You knew exactly where I was going with it. Yeah.
I've seen all of these different studies, and I would say all of these financial vehicles, they have fees in it, right? They have.
Yes.
What you want with any financial vehicle is, and this is kind of my philosophy too, is I like to pay the majority of the fees up front. And just get it over with instead of having a fixed cost throughout the life, 20, 30, 40 years of a particular, vehicle. Because we've all seen the John Bogle studies, at Vanguard, which is not too far away from me, just on the other side of town, of how these can eat into your gains. But yeah, there are costs. The majority of them are upfront.
Okay. And who controls the investment portion? That portion you're saying is about 6%. Who's overseeing that? Does the purchaser of the policy have any say in how it's invested? Are there tiers of risk that you can assume, like in a traditional sort of investment vehicle? Or is that just when you sign up for that particular policy, that's what you're agreeing to? And also, is that fixed for the life of the policy, or are there different terms within that of that rate?
That's a great question. So when you buy this a dividend-paying whole life insurance policy with a mutual life insurance carrier, as I've shared, you are a shareholder in that mutual life insurance company. So they run that company on behalf of their shareholders, which is you, the policyholder. Where that dividend comes from is that's the profitability of that mutual life insurance carrier that they share with their shareholders. So they have an investment portfolio, which is in real estate, different types of real estate, whether it's equity, whether it's debt. They have a large corporate bond portfolio with corporations with very large cash positions. They have an alternative asset portfolio. They have all of these, different allocations. So that's where that comes from. And you don't have any input in that per se. They have their asset managers that manages it in line with the philosophy of the company. And what I always say to folks, because somebody asked the other day, how has some of these companies performed during the worst times, like financial crises and so forth? I said, well, in 2008, 2009, 2010, there's mutual insurance carriers that paid between 6 and 7%.
Wow.
Still during that time. And then the other thing that it's kind of comical if you think about it. They've been around since the mid 1800s. So some of these carriers, just think of what they've already experienced. They experienced a civil war in the United States. We had two countries, two Congress, two presidents, two militaries fighting each other, and they were still profitable. They experienced the massive financial economic booms and bust cycles. They experienced, the creation of the Federal Reserve in 1913, World War I, the Great Depression, World War II, the Bretton Woods Agreement, 1971, Richard Nixon takes the world off the gold standard. 74, you had the petrodollar come in, standard for the world. Then the dot-com bubble, the 2008 GFC, the great financial crisis. And most of these companies have paid dividends, which is profit back to the policyholders, consecutively for over 170 years. So they didn't skip. Now, it does fluctuate the amount that it is. 6%, very, very good, obviously, dividend. If you look historically, but they've been higher and they've been at around 5% too. So yeah, that's the one piece that's not locked in, but it's not very volatile. It's been about in that range since I've been doing it personally for almost 2 decades. And if you look at their dividend history throughout time, they've done very, very well. And it's been much higher during times. But yeah, that's a pretty good track record if you look at it back at about 170 years, right? Try and find companies listed on the New York Stock Exchange that's been around for 100 years, and then try to find companies that have been profitable every single year for 100 years. It's it's a pretty impressive statistic.
Yeah, I love the history side of that, to see that over through good and bad times, because that's another concern, right? It was through COVID, same. They withstood that as that barrage as well.
Yeah, here's the craziest thing about the whole COVID thing is I needed a policy loan to fund something, right? And this
during COVID, during the sort of worst part when everything was
the worst part. Like, I think depending on the state that you were at, in the state that we were in Pennsylvania, on Wednesday, they said by Friday, everything has to be shut down.
Yep.
And I'm like, oh, I need cash. I need, so I sent in a policy loan. And as the carrier even went virtual offsite, because all the employees went into houses, that still was processed within 48 to 72 hours.
Wow.
I think it was 2 days they processed that for me.
Is that a tough process overall to call on that, or to withdraw for funding your own personal, sort of calling on those dollars from the quote unquote bank?
Not at all. So there's 3 ways that you could do it. The one is directly from the insurance carrier. We have operationalized that for our clients, where they just fill out a quick form, they submit it, we get it, and we take care of the rest. And then there's also other strategies. In some cases, it does make sense to set these up with banks. Okay. You get a large windfall. There's a fantastic strategy that we have using this life insurance strategy, where you can instantly set up your banking system. And then when you do set it up with banks, they have a revolving line, and most of those life insurance lines of credits, they come with a checkbook access. So you'll be able to write checks just like you could do with a lot of HELOC programs.
Okay. So it's not necessarily a promissory note type of situation. Is it for each time that you draw off of that? Or, because just thinking of how you would structure the payback, and my next question was going to be, who determines the rate at which it has to be paid back and the terms of that?
Yes. So the first piece is with the insurance carrier or the bank. The second piece is then setting and structuring a note for your business, and then setting the interest rates. Okay. And it's just a contract that you have, your family trust, let's just say, where the family bank is inside of, with your business. So around 5% is your borrowing rate from the insurance carrier right now. Then you set, and I mean, we just advise people to look at fair market rates, what the rates are, and you could set that for your company, and then set up a note. And again, explore with your CPA if this is going to move the needle for you. But again, there's 2 pieces of it. The one piece is getting the capital, let's just say the family bank, the family trust gets the capital. That's the one piece. And then the second piece is setting this up for you and your business and your practice, which is, that you're in full control of that part too.
Okay. Yeah. And just to repeat for people, there are advantages to getting the highest fair market rate to charge your business interest at. And I know people would say, why would I charge my own business more interest? But again, if that's your highest tax structure, and you can get as much to reduce that taxable gross income in that entity, you are going to help yourself a lot, because you're actually getting a kickback of the interest anyway on that margin that we started talking about back at the beginning. Because some people might hear that and say, why would I want my business to pay more in interest? Well, if you're dealing with just third party bank, you don't. but if you're dealing with a way that you can get if there's an upside to you as the bank, you obviously want more interest in that, right?
I mean, I think that's like the most powerful statement from our conversation, because it's, why would I want to pay more interest? Well, it depends who you're paying interest to.
Exactly. If you're the bank,
just paying it to a commercial bank, you probably don't want to do that. If you're paying it to your bank or your family bank, yeah, you would actually want to pay as much as you can.
Yep. So anything else you can think on that? I really appreciate the depth you went into. This is kind of it's a confusing area for a lot of us in the professions. And I have a lot of laypersons that listen to the show as well. And I think it's great that you address the fact that, look, you don't even have to be in a profession or own a business to do this. There are additional advantages if you do, and if you are. That being said, it can be for anybody. And I remember with Cashflow, we were actually just talking to my younger daughter at dinner the other night, dinner table conversations about Cashflow, the board game, right? The board game Cashflow 101. And she was saying she wanted to play because she just read Rich Dad, Poor Dad. And we were just kind of having a conversation about that. And we were trying to explain the general concept of it. But again, the concept is getting out of that cycle. You don't need to inherit or make $1 million to get out of what Kiyosaki and Rich Dad call the rat race, right? You
Correct.
just need to start managing cash flow. It's all about cash flow management. On my website, you guys can go to it now, theorthocoach.com. When some pop-up blockers block it, and if it doesn't pop up, email me, Dr. Mike at the Ortho Coach, and I'll email you a copy of the balance sheet. But I built a custom balance sheet that's all customizable. It has templated income, expenses, liabilities, and assets so that people can go in and start to fill it out. And there's some instructions in there as well. And I even did a little podcast episode. I can link it up to this show where I talked about how to fill it out, because I want people to start to know your numbers and your money and look at where your money is really going. And if you can just create that margin, mentioned Dave Ramsey. Yes, that's one side of it. I feel I have nothing against Dave Ramsey. I think he actually, for a lot of people, does a lot of good for them. He is definitely right. I think he's kind of an 80-20 guy though. He's kind of playing to 80%, the averages. He knows most people just are somewhat debt averse and they want to play it safe. They want to have a comfortable life. They don't want to be mired by debt. They want to get to a point where they can retire and live with some amount of comfort, or at least not much discomfort in the retirement years. And as you said, that's the majority. That's the average and the majority. So he's smart. He's got a business and a market and he's marketing to that. That's not the only way to do it. There's so many other ways, and the rich don't get rich with that strategy by and large. I think we could both agree. Like it's not impossible, but the key is, to me, what you do with that margin and not being afraid to leverage other people's money. And what's interesting about this strategy is it takes it to the next level of leveraging other people's money, but with a little bit of a kickback to it being your own money in a sense, right?
Yeah. We've all heard the saying, your money should be working, hard for you, right? And you shouldn't just be working for money. Let's get the money out there working hard for you. But I would add to that and say, not only does your money need to be working for you, instead of you just working for it, it should work and it should be working hard. It should be working hard and smart for you. And this is just one of those strategies where the same pool of money could be working in multiple places simultaneously. If your listeners are interested in learning more, I wrote a book called Get Wealthy for Sure, the #1 financial strategy for business owners to multiply wealth predictably. And in the book, I share the track record of 170 years, and I go more into depth of the specific strategies with case studies, and also go into frequently asked questions, and also talk a little bit about a family office framework. So if they want to go to getwealthyforsure.com, they can download a free ebook and an audiobook. Since you're listening to this on a podcast, I know you'll appreciate listening to the book. Again, that website is getwealthyforsure.com, getwealthyforsure.com, and you can download your free ebook and audiobook at that URL.
I appreciate that. Thank you for that. And I'll put links in the show notes as well. And before we hop off, Cashflow Ninja podcast, talk to me about it. How'd you get into podcasting? It's a well-known podcast. And what do you talk about on the show? How long have you been doing it? And how do you like it?
Yeah, that's been quite a journey too. 9 years, right? I started the show
9 years.
A year after I started Producers Wealth. And it all just started because I was having these incredible conversations with people where they would share, business strategies, investment strategies. And, so for 9 years, we've been interviewing folks covering so many different asset classes. I mean, we've covered everything from coffee farms in Panama to doing infinite banking with gold in the Caymans to crypto we've done all kinds of stuff. But it's a lot of fun. I love to learn. I'm a student first and a lifelong learner. So I love to learn and continue to learn weekly, just from some very, very interesting folks in the world of business and finance and the investing world. But there's been some interesting guests throughout the years and adventures and people that I've met. I can't believe it's been 9 years already, but it was just a passion project. I just wanted to have fun with it. And before you know it, we were on all the charts on iTunes and, downloaded in many different countries. So it's been a blast.
Yeah, it's a fun journey. And you started out, and I've told this story many times. I always joke, I had this great idea to podcast, but my wife actually was like, you should podcast. You like talking to people. And it was the same thing. I love hearing people's stories. I love learning. I can't tell you how much I have learned doing this show, and not just while I'm actually conducting the interview, but when I hear things, it makes me think about other things I should learn more about, right? You're like, well, I knew that was a thing, so I'm going to look into that. And then someone puts you in touch with someone else, and it just starts to grow this network. It really is fun. It's a lot of work. It's a lot of time. It's a lot of energy. But if you're cut out for it, it's a really fun way to generate content. And on your note of, countries, I got a badge from the company that pushes out my podcast. And I reached 100 countries. I'm like, 100 countries.
It's crazy.
Right? It's like, it's digital media, the way it's consumed. It's crazy. I'm like, oh my goodness, people are consuming this content around the world. So it's really cool that we have this platform.
Yeah, it's been a lot of fun, and you just keep learning and keep meeting incredible people. So if I had to look back, it was one of the best things that I've ever done.
Same here. I completely agree. It's grown more than I ever imagined it could or would. And only 2 years in, a fraction of what you are. I'm just so continually enthusiastic about this, and the feedback I get from people and how much it's helping them. It just motivates me more and more to keep doing it. So that's great. It's been a really fun conversation, MC. I appreciate your honesty and going into detail on a lot of very detailed questions with this. I know it'll help the audience, but as I said, I have a really high IQ, intelligent, and information-seeking audience that doesn't want to just hear the 30,000 foot view. They like digging down into topics. So I appreciate you taking the time to do that.
Absolutely. Thank you so much for having me on, and thank you for listening. It's been a blast.
It's been a lot of fun. If people want to reach you, I do have the getwealthyforsure.com Cashflow Ninja podcast. I'll put links to all that. If they want to reach you specifically, if they have questions on this topic, or reach you in for Producers Wealth and want to learn more about your company and what you offer, how would they do that?
Yeah, absolutely. Producerswealth.com is the website, and feel free to just email me directly at mc@producerswealth.com. That's mc@producerswealth.com.
Awesome. MC Laubscher, absolute pleasure. Really enjoy it. Thanks so much for coming on.
Thanks for having me.
All right. Bye.
Bye.
Thank you for tuning into this episode of the Doc Podcast. Be sure to visit theorthocoach.com to get access to ADA CERP recognized CE courses, or to schedule a private one-on-one coaching session with me. Also, if you know of someone who would make a great guest for this show, or if you'd like to be a guest yourself, please email me at drmike@theorthocoach.com. And be sure to join the Doc community on Facebook for more great content. Thanks so much for listening, and always remember, you have been blessed with the ability to do amazing things.